Good afternoon and welcome to our Lunch and Learn workshop. So yes, you can bring your lunch along to this wonderful workshop with KPMG with our partnership. I'm going to hand over to Kylie Little to introduce this wonderful session on Startup Finance 101, everything you really need to know. Because it's important to get these ducks in a row before you launch your incredible climate tech solution into the world. But before I do, I'll introduce myself, Charlotte Connell, looking after community here at Climate Salad. And I'd like to acknowledge the traditional owners on the land of which we meet. For me, that's the Gubbi Gubbi people. Please feel free to put what country you're dialing in from here today. And I pay my respects to their elders past, present, and joining us on the call today, and honour their continuous connection to country, land and sea. Over to you, Kylie.
Excellent. Thank you, Charlotte. So hi, everyone. I'm Kylie Little. So I'm from the KPMG High Growth Ventures team. So we are focused on just working with startups, basically, where we sort of understand the space you're in, we understand your needs, and we're really focused on figuring out the ways that we can work effectively with you to connect you into the services at KPMG that can actually help you grow your business. I'm just trying to slide this across because I've just completely lost my notes. There they are. So for anyone that sort of is not familiar with these lunch and learn sessions, we've been working with Climate Salad to really try and find ways that we can get you guys access to that expertise across KPMG. So each month we run a different session where it's really a chance for you to jump in and ask questions as you need. So put your hand up, ask whatever you need as we go through. We've got a couple of amazing people on the line and we'll run through some questions with them to start with to warm you all up so that you feel comfortable asking your questions, but obviously jump in whenever you need to ask whatever you would like to. So today I'm joined by KPMG partner Leanne Hegarty, who leads our outsourced finance team. She specialises in working with startups to structure their finances to support their growth. So Leanne and her team are working with a lot of our clients right now as they grow and as their business needs change. So she understands really well the challenges you guys are all facing. Leanne also comes from a business background, so she really does understand what it is that you guys need. So welcome to Leanne.
Thank you, Kylie.
We're also very excited to have Mac Christopherson from Mad Ventures joining us. So Mac is really interesting for this conversation because he brings an investor lens to really help you understand what investors really want to see at different funding stages. Over the last 2 decades, Mac has built ventures as a founder, commercial director, country manager, CFO, and advisor, and he's driven ventures in growth in ventures from idea to scale. So Mac really does bring a unique perspective today because he understands the experience as a founder, as a CFO, and as an investor. So really interesting for you guys to tap into that thinking from Mac's side of things. So welcome to you, Mac.
Thank you very much.
So let's get started. So for founders out there with limited financial background, I guess, and even some that have some financial background, it can be really challenging to understand how you set up your finances and how that should change as your business grows. So many founders also struggle really to understand what investors want to see when they're heading into funding rounds. In today's discussion, we really want to help you better understand what resourcing you need as you scale, how outsourcing can help you navigate those different growth stages, when to invest in an outsourced team and sort of what's the thinking around what that team should look like for different types of businesses, and how to ensure your finance capability is set up in a way that you can support longer term growth. So we'll jump straight in. And then, as I said, if you want to put up your hand and I'll just keep an eye on the questions as we go and see where we need to feed those in. So Leanne, I'm going to kick off with you, but Mac, obviously feel free to jump in because you've got that CFO lens as well. So jump in as you've got things to add as we go through as well. So Leanne, you and your team work obviously with a lot of startups across lots of different stages. Interested to understand from you, I guess at the outset, what are the biggest challenges that you see that you come across for founders and their teams trying to get a handle on their finances?
Fantastic. Thanks, Kylie. Look, and what I'll say, so in terms of challenges, you're not out there on your own. And so sometimes that challenging thing is I'm on my own. How do I do this? How do I do that? And as much as you might all have unique products, I'm going to say in terms of this, particularly this finance piece and getting an understanding around it, you're not Robinson Crusoe. And in terms of when investors are looking at this, they're not expecting you to be CFOs. They're not expecting you to be accountants with qualifications and understanding all the nuances of how to record and what to record. But the challenges, though, that they continually face is you understand your product, but you don't understand your business. And they're two quite different things. And so you might have a very, very, very unique product. Nobody else is out in the market. You've done a whole bunch of research in relation to customers, competitors, and those sorts of things, what the landscape looks like. Good, but do you understand the business? Do you understand what are your levers? What are your drivers? If it changes by this percent, what's going to be the impact on that? Yes, you would, and again in this founding space, you would have all heard about CAC. Yeah, what's your cost of customer acquisition? Good. You'll probably understand often people, what's your payback period? What's your gross margin? Good. But can you run a business? Do you understand the commercials of your business? So that challenge piece is around how do you get that understanding, and who are people that you can turn to help you go up that scale of building those competencies about understanding your business. And I'm sure Mac will just jump on in here, Mac, as an investor looking at this, is that people come in again, I keep saying they keep selling the product, but investors want to know, well, that's good, but can you grow? Can you grow profitably? And what's your cash? So yes, you might have profits, but profits doesn't eat cash. Do you know what that means? If you change this driver, what does it do to your profit? If you change that lever, what does it do to your cash burn? It's the commercials around the business that you've got to understand. And that's what I find founders really have a challenge understanding the commercial aspects of the business, not just their product.
Yeah, I'll jump in there.
Yeah.
I agree. At least some founders struggle with that. And one perspective that I encourage everyone to think about is that everyone thinks about they're going out to investors and pitching their idea to investors, but you're all investors. If you're founders, you're investors. You're investing in your business. It might not be necessarily cash. Probably a lot of you are putting in cash, but hell of a lot of time in your life into the business. And if you don't understand the drivers to your business, which is what other investors are looking for, they want to know that you're across the financial drivers and the growth drivers of your business. So I think that's the most important thing from a financial perspective that investors look to see from founders that are pitching, that they really understand their business from a financial perspective and what a change here does over here and how it results in greater revenue, greater profitability, or, greater cash burn. So that deep understanding is super important.
And then in terms of, how you get that across, like what are the things that a founder could get right that actually shows an investor that they do understand? Like, what are the things they could be doing that show they do understand those numbers, or they have their finances set up well?
I think, well, if they're in a pitch situation, then presenting, I like to see the unit economics. So for every unit of whatever they're selling, what's the profitability of that unit? And then how that's broken down. So demonstrating that they understand all the bits and pieces within that individual product sale, what the cost of sale is, the CAC is, and their profitability, what the direct costs are. Like just showing that deep understanding of a per unit sale and how profitable it is. That's super, super important for an investor to see from a founder when they're pitching.
And I'll just jump in there too, and so when, like, as Matt keeps using that word business, and I've used that word business too, sometimes what we see is when people think, we particularly say they're going to this pitch and that, okay, I've got this many revenue, product sales or subscriptions or whatever it might be, and then yes, this is going to be this profit. And people have this idea that I've got to, in quotes, build this business. And then in building this business, they say, well, all this money comes in, you start to build this enormous infrastructure. Then all these people start to come in to this business. So there's this idea that if there's more people involved, I've got a business. Well, not necessarily. And again, I would say, whether you're getting funding or whether it's investing or whatever it might be, building this business, and again, it's around efficiency of growth as well and profitable growth. So just having more people in doesn't give you a business. And so again, to Mac's point and what we're saying about understanding these levers and drivers is how are you also growing efficiently, that efficiently being profitably. So are you using other different technology? It might be robotics that you might be using. you've got specialist expertise, that you're just not building people and noise into your product to give you a sense of business. That doesn't make a business, and that, if anything, shows that you don't understand the business and the commercials. Because how are you growing profitably? How are you growing efficiently? How are you using the cash that you're generating to continue to grow?
And it's probably one that, I mean, we might have a look at the funding sort of side of things, like that piece about going into funding. But then I think actually coming back to that for founders and for startups, where they're actually, their first stage is not looking at being profitable, but their first stage is, how do I use the money well?
Yes.
And what do I do if I've got a lump sum of cash sitting there? How do I use that effectively? But we might start with talking about the funding side of things, because I think everyone, top of mind for every founder we know is either the round I'm about to secure, or the next round. And like, you know, once you've got one, you're just starting on the next one again. So Mac, I guess, given every founder, that is their most important focus. It's interesting to understand from you how important you see is that financial acumen of a founder. Like, how much does that matter to you? If they have it, like, what does that mean? If you feel they don't have it, like, how do you think about that as well?
Yeah, okay. So I don't think there's any expectation from investors that a founder is the CFO themselves. They could be, but there's no expectation that they're an accountant or a CFO.
Yeah.
But I think it's important that they know what they don't know, and that they have the right people around them.
Mm.
When I see founders who don't have the right support around them, and they clearly don't understand their financials, that's a little bit scary from an investor perspective, because you don't want to be putting money into a situation where it's not going to be managed effectively. Yeah. So it's important for a founder to understand what they don't know and have the right people around them, and also have enough of an understanding and get themselves literate enough to be able to know when they're, when something doesn't smell right.
Mm.
Sorry, I was just going to ask a question. What are like the top 3 points that a founder should know, when it comes to their financials, for example, or what are the most important things to know?
So I think we've touched on the financial drivers to growth. I think deep understanding for your particular business what the financial drivers to your growth are. I mentioned unit economics before, so understanding unit economics. And then a big one is how you're managing cash, and what your burn rate is, and what you're achieving with the capital that you have. So that's tied into that cash management piece. So if you wanted 3, that's 3 I'd say.
Yeah. And then thinking about the sort of the how you pick up on the financial acumen of a founder, like through reporting and that sort of thing. Are there particular things that you see that come through that tell you, I can see that they understand what they're doing?
Well, I can tell you one that I have seen a lot that stands out is that when people get the concept of cash management and profit and loss mixed up and mix up those 2 concepts, that's an instant giveaway that they don't quite have it. So that's I suppose on the negative side. On the positive side, it's again coming back to those 3 points that I just mentioned. If they can articulate and describe those well, and how they're driving the financial levers within their business, understanding the unit economics and how that works, and managing the cash, I think that gives confidence to an investor.
And what are the key reports that you want to see from them? Like at the point that you're sort of getting serious about investing in someone, what reporting do you want to see?
There's a standard set of reports that I'd expect to see, which is what's called a 3-way forecast, which is profit and loss, the cash flow forecast, and the balance sheet forecast. With that, you've pretty much got the business and understand it from an analysis perspective. Again, I go back to understand the unit economics and seeing that, and we look at the market size as well, which we apply a multiple of the unit economics based on what we think they can get in terms of market penetration. So that's how we assess a business. Back to that reporting question, P&L, cash flow, and balance sheet forecasts. And one mistake that I see quite often is that, especially in early stage businesses, founders are reluctant to share actuals, or you either get actuals or you get a forecast, and not both of them together. I think it's super important that you're transparent about where you've come to today, and presenting a forecast going forward is, again, super important. So don't go with one or the other, go with both.
And do you think sometimes that's because they're not confident, or they're nervous about what the actuals, like, maybe they either not understanding or not being sure whether they're right, or?
Potentially a bit of both. I think it's mainly the confidence around the traction that they've actually achieved.
Yep.
But the reality is, an investor, unless they've got, going in and just throwing money around willy-nilly, they're all going to go to the detail, and you'll eventually have to share that. And I know every founder in their pitching wants to frame the best possible version of what they've done, and I don't think there's anything wrong with that. I just think that you've got to be prepared at some point during the process to be disclosing your actuals.
Yeah. And then, Leanne, we're actually going to come back and talk a bit more back through the sort of the setting up finances and outsourcing and that sort of thing. But I guess on the funding stage, it's probably interesting to understand, how does your team support the businesses you work with when they're going into those funding rounds? What are the things that you're doing that would actually help them through that process?
Well, that really sort of, I suppose, flows straight off what Mac was saying, and from a finance function perspective, that P&L, balance sheet, cash flow, that's standard, and not having that's kind of deal breaker stuff. You've got to have it. And what we often see is people come like, oh, I've done my P&L, here's my balance sheet, here's my forecast, good, and here's my cash flow, and they're completely separate documents. And they've been prepared completely separately and in isolation to each other. That's wrong. Like, bottom line, that's wrong. You can't. It's to get it to be correct, to get it to be meaningful. They actually all integrate with one another. And so where we help is we help to, I suppose, take founders through that journey of understanding how, if you spend money here, well, what's that impact going to be on your balance sheet? If you spend that money here, what's the impact on your P&L? If you make this profit, what's that impact on your cash? And in terms, yes, that might be cash. That cash, balance sheet, P&L, cash, balance sheet, P&L, they are all interrelated, and you can't do them in isolation. And so you can have that from a historical perspective, but then the forecast similarly is not just, well, here's my sales and here's my outgoings. Again, it's that forecast in that here's my revenue, here's my expenses, this is impact on balance sheet, this is impact on cash coming in and going out. So where we help is to frame that, effectively really produce the picture that is the right picture in relation to what they want to present. Now, but having said that, to Mac's point, it's all well and good, this is what I want to show versus this is what's going to actually show. And so it's also working through and helping with that journey. Okay, well, look, what do you realistically think you're going to achieve? And again, how do we present that in a three-way, effectively a three-way model is what we call it. And then understanding that piece that profit is not cash. Profit is not cash.
There's a couple of questions in here relating to stage, but probably for both of you, maybe for you, Mac, in terms of the investment side. So one of the questions at the pre-seed stage and without any real funding, it's very difficult to provide this three-way information. It's so flexible depending on what we're trying to achieve. This changes once you have some cash to spend. And then the next one, it's actually from Raj saying, I'm currently raising a seed round. I found that investors did not expect any financials, have not asked for any forecasts. So just interested to understand, from a stage perspective, what are the sort of things you would want to see, Mac? And then Leanne, from a stage perspective, where's the point that, that three-way reporting can really kick in effectively?
I think it might depend on the investor. If you're going to professional investors, then I think they're going to want to see financials. If you've got a personal relationship with a high net worth who believes in your vision and they're willing to put money down without seeing financials, that's awesome. I think that's unreal if you can find that person who is willing to back you. But in my experience, they're reasonably few and far between. So I think earlier stages, yes, the level of depth and can be lighter, because there isn't the expectation that you've got lots of transactions. But a three-way forecast like we're talking about is, as soon as you've got any transactions happening or there's any money being spent, you can produce that information. And it's not, might sound complex, but it's not that complex to produce. And if there's a disconnect between the three of them, then that can make investors a little bit scared. So just back to your question, in terms of stage, by the time you're getting to Series A, then there's obviously a high expectation that you've got that information. At a family and friends round, yes, you might get away with not having as much information, but I think I'd encourage that you drive into setting up this structure as early as possible and getting into the discipline as early as possible, because without it, you don't have the structure to make sure that your business is going to survive.
Yeah, and it's interesting. So I think all the research we did last year when we were talking to VCs, founders, and the people in our business that do the sort of all the work to actually support startups. What really came through was this sense that if you get in early and you get the foundation right, and that discipline and the foundation, if it happens early, it actually sort of flows through in a really meaningful way as the business grows, because everyone sort of understands what they need to do, rather than getting sort of to a more advanced stage when they're busy and hectic and then trying to unpack the whole thing. So have you got anything that you'd add to that, Leanne?
Oh, yeah, definitely. And I think to Mac's point, that I was just looking at some of the comments, and when you're really, really early, it's like, oh, it's really hard to do. Well, you might have 2 transactions. It's still going to be P&L, balance sheet, cash flow. You might have 200 transactions. It's still P&L, balance sheet, cash flow. So when you set up right from the beginning, that discipline, and again, this is that learning, and this is where we really help a lot of the founders, is to understand that as to how they're interrelated and how that goes through. And then what that does is really helps in your conversations. And then the step being, I understand my drivers of the business, because when I invest X dollars or this much money comes in, or I spend this is the impact through my P&L, my balance sheet, my cash flow. And so it's, when is the right time to do these? Right from the beginning. And as you grow, all you're doing is adding extra columns. That's truly all you are. You're adding extra columns and you're adding additional extra zeros onto the transactions. That's all you're doing, but you've got that discipline up front. And also, when you start doing it as early as possible, you're learning, when you're learning it with less transactions, less complexity, when it comes to here, it's just a variation on a theme. And so you've got that understanding and you can talk to it a lot better. You can then also understand the impact of when you adjust a driver, a lever, or whatever it might be, when you adjust something, or this changes by 5%, you can then understand the impact of it. And then when you've got an investor with money coming in, again, that comes in, okay, this is how it's going to be spent, and this is what's going to happen later. And this then also flows through. So as much as we're talking about P&L, balance sheet, cash flow, down the bottom of all of these, it's sort of like, okay, well, once we get to this, well, then you can also then start to forecast, well, this is the impact of my payback period. When you start to grow, then you can start, like in the beginning, every cost is fixed. There's not a lot of variable necessarily, but then you can start to work through, okay, well, hang on, what point do I get that my costs become variable? Yes, I'm talking about my CAC, but what's my retention costs? So all of this flows into those sorts of things. And these are all the things that are understanding around the business of it, not just the product.
And one thing I want to add to that is, I think when finance people sometimes talk to all this information, it sounds complex and it sounds like lots of work and it sounds like it's a distraction and it's a lump of lead that you're having to drag along. I think and encourage that everyone views the finance function that they've got within their business as an enabler and supporter to enable the growth that you all want, as opposed to viewing it as something I have to do. I think if you reframe that for yourself, you'll get more out of the finance function that you're working with.
Yeah. And so if we think about what a finance team would look like, and again, obviously very early stage, you don't need a finance team, but you need some core functions that are in play. So it'd be interesting to hear, and you've both got the CFO hat. So I think it's interesting from both of you, like from early stage, what are the core things you need in place? I think when we spoke, there's nothing really common for every business. It's going to be different for different businesses, but it's interesting to think about what are the core things you need to be getting right, and any sort of common themes you've seen around where it sort of makes sense to be adding up and layering up that resource as you grow.
Okay, thanks. Yeah, look, and again, everybody's got their own story, and you know the question is, what level of revenue should I then employ X person? It's not necessarily a revenue piece. It's got to do with volume of transactions, because you could have $10 million in one transaction, or you could have $10 million in 10 million transactions. So very, very different. And what you've also got to think about, it's like, it's initially I'm, going by bootstraps, and I can do the payroll, I can do this, and I do it in front of Netflix on a Saturday night, and it's fine, and I'm saving myself X numbers of dollars. And look, and that's okay. Or my partner does this, that, and they record everything. And again, that's okay. But what you've got to think about too, in terms of doing that, is that you are recording, you are processing the transactions. And what you're generating in that is just data. You're not generating information. And again, they're two different things. You've got the data, and then it gets converted into information. And everything that we've been talking about up until now is information. And it's when you're getting, and it's sort of the point is that, well, what's the opportunity cost of me not having information? Is that if you're out there and you're selling what you're selling, investors are asking these questions. It might be a high net worth or whatever it might be, but again, they want information, not data. And being you able to talk through the information, that's what's going to help you sell. It's going to also give you value and confidence, like from an investment, confidence in what you are selling as well. So again, and it's not about employing a $350,000 a year CFO. You can still do the bookkeeping and recording of the transactions, but then it might be an outsourced financial controller or finance manager, maybe 2 hours a month, just to produce, again, those basic reports and put a little bit of commentary around taking the data and turning it into information. So again, there's never necessarily the right stage, but the sooner you can get into information, as soon as you can put these sort of governance, risk, and those sort of processes in place, as you go through growth, it grows with you as well. You get a better understanding for it. You get that gut feeling when things aren't quite right, and it helps you do things efficiently, profitably. And it also, what it does is it gives you somebody else's completely different perspective on looking at the numbers. That you sure that's right? Whereas when you're in the depths of it, sometimes you don't see those things. So it can go from literally a couple of hours a month to a couple of hours a week, and it just grows as you grow, is when it makes sense, when you need information.
Yeah. And any thoughts on that, Mac?
I think it's horses for courses. So I think a founder who has strong financial background needs a different team to someone who doesn't. I think there's always a need for processing transactions, and as Leanne said, that could be you're doing it in front of the TV on a weekend when you're small, but over time that's going to get bigger, and you'll need that bookkeeping function. So again, it's horses for courses. It depends on your particular skills and the skills of the people around you, and the availability of time from the people around you, and your time to do it. So yeah. I know.
I was one of those that just started out doing my own bookkeeping, because I just went, well, how hard can it be? And then the transaction volume got really high, and I thought, no, it can be really hard, and I actually don't know what I'm doing. It was like a game changer when I actually got help.
But to that point too, though, again, thinking when I go to that opportunity cost, is that, again, look, an hour a week or an hour a month, and again, it keeps you aware of what's going on.
Yeah.
But once it starts to grow to that, well, could you be talking to somebody else about your business? Could you be talking to somebody else about this? Could you be researching an update to your application or whatever it might be? So really thinking about where your time is best spent. And again, Matt, look, some people are good at this. They can just do it and actually enjoy it. Other people are like, sucks their will to live, which again, I totally understand too. But it's really a matter of thinking about letting everybody do what they're good at, and having the right people around you and supporting you through your growth, educating you through your growth, and you do what you're good at, which is your product.
Yeah. No, I
think that's
yeah.
sorry,
Sorry,
super important point is if you are starting out not being particularly financially literate, finding someone who can go on the journey with you and educate you through the process. In my roles as CFO, one of the big tasks that I've set myself is building the skill level of the founder that I work with, and giving them an education, and that's super helpful for them to grow as into the founder and CEO that they're going to be to grow a great business.
Yeah.
And do you agree, Mac? Sorry, Mac, do you agree too? And this is the thing, I think in these sort of roles, it's not about the CFO or the accountant being the superstar. It's not. We are the support function. And it's about what we can do to help you, the founder, the CEO. It's to help them and support them be the superstar and to get there. And our role, it is very much about support, education, getting that information across. That's what our role is. It is to support.
Yeah, and it's interesting that the Founder Elevate program that we launched last year, that came about through conversations with VCs who said we keep coming across founders who need to increase their understanding of their finances, of their financial function, and just understand their financial management. But they don't need to go and do an MBA. They just need to understand the core. They need to understand the basics. And so we actually launched that program off the back of those conversations, where they were saying we just want them to understand more. We don't expect them to be CFOs, but we do want them to understand it, and we want them to understand who they're working with and that they're choosing the right people to work with. So it was a common sort of feedback that we were seeing in the market. So in terms of like biggest mistakes that you guys have seen, have you seen anything that you would say where someone's kind of either gone down the wrong path or like something where it hasn't really worked for them?
I've seen plenty of mistakes. It's picking out the right ones. I think a more recent example for me has been where they haven't had the right support in place, where they've engaged an external party to support them that wasn't doing the right job, and the business and the founder held onto the relationship for too long and didn't do something about it, which created a bit of a snowball effect. And they've gone to raise some capital with that structure being in place, and it's meant that they've had to kind of take a big step back. I've encouraged them to appoint an alternate group of people to sort out the finances, so that they can go into an investor meeting, because they can go and pitch a wonderful business, but then when it comes to DD and they look under the covers and see a mess, then they're not going to get the investment. So I think it's important to recognise that you get the right support for the stage that you're at.
Okay. And
yeah, I'll throw in on that point. I've got my daughter's 14, and at school they learn about friendships, and friendships change over time. It's exactly the same. But it's exactly the same as this. And look, and I'll say from my personal experience, I was a CFO in a very, very large retail startup, and I was employee number 2. And I was that person that was from 0 revenue up to here, but I wasn't the person to take it through the next stage. And that's exactly where you're at. So if you're pre-seed, just starting out, absolutely nothing, you find that the relationship that you've got, and look, you may end up with somebody, a set of advisors, or your support function that takes you through various bits and pieces. But it's different skill sets that through different stages of where your business is at. It's a very, very different skill set for the people that you think I'm at IPO versus pre-seed. And that's where everybody should be honest about, again, the support role that they play and at the stage that you're at. And it's also, there is nothing wrong we can never get rid of our hairdresser. You can get rid of, in terms of this person.
You can. I can tell you can get rid of your hairdresser.
Get rid of your hair first, yeah?
But that's not the wrong thing. And I think, again, but also getting that right support function. If they're also worth their grain in salt. They will also be honest about it as well, in terms of, we're at the stage now where you need some additional expertise, you need additional support in these areas as well. And so I think that's also, when you're looking at who's going to support you when, that you're working with people that have sufficient self-awareness to understand who's good at doing what at what stages, and that they know when is the right time to step back.
And we're just going to really, oh, sorry, Mac, we're going to say something?
I was going to go with another example.
Go.
I think one thing that's super important, and you can easily make a mistake with, is your cash management. And so I've seen it a few times where founders raise a pile of money, and pile of money means different things to different people, but raising a pile of money, and then the relax on cash management. I'm rich, I can spend here, I can spend there, and it's surprising how fast that money disappears. And having without the discipline and having a gated spend, and what I mean by a gated spend is spending money based upon achievement of milestones, whether they're revenue targets or other growth targets, and having that match a budget is super important, because you quite often see it with seed and maybe Series A businesses where they've raised money and their revenue doesn't track as they budgeted, and all of a sudden they end up with a cash hole. And so that's a cash management for startups is the number one. If you don't manage your cash well, then you end up falling in a heap.
Okay. And I've got quite a specific question here. Would you mind speaking a bit about how you'd think about financials for an early stage pre-revenue deep tech company where the majority of spending is on R&D and building a pilot plant of the technology before sales can be made? So customers want to see it proven first. So what might you expect to see in terms of setting up finances?
I'll go straight back to what I just was talking about around cash management. You've got a set of milestones, but they're not necessarily revenue milestones. You've got product milestones or market acceptance milestones, and achieving those with the amount of cash that's allocated to them, because you're given a portion of money to achieve certain things, and it's managing that cash and the spend around achieving those outcomes is what's most important. And so I'd expect to see a cash flow, cash flow that's built around achieving those milestones.
Okay. Anything for you, Leanne?
No. Yeah, absolutely. Well, we keep coming back. We keep talking about cash, and understanding the implications of the left and the right. And look, and just to Mac's point, when that money comes in, so often that we see, oh, great. And then I come back to that point about, I suddenly build this business and I employ all these people. Head count does not make a business. And again, we come back to efficiencies. What are the drivers? Where is it? Where's your money going, and what's your burn rate in it?
Yeah, great. And then if we go back to sort of the outsourcing model, because obviously everyone generally early stage, everyone's outsourcing somehow, whether they've got a bookkeeper or they've got an external accountant or whoever it might be. And I guess it's just interesting to understand sort of as you grow, how can that outsourcing function like work? You know, so I think what we see that's interesting in here is we work with companies who might use us for their outsourced finance function quite early. They might then bring someone in-house, and then they might bring us back in because they want additional advisory support. And it's quite a malleable offering in terms of being able to sort of step up and down through the growth of the business. But it can actually start quite early. So I think it's just interesting for you, Leanne, to actually talk about what does that look like? Where is the ideal point that we start with companies in here? And then what are the different ways that outsourcing function can work for those businesses?
Thanks, Kylie. I often, when I talk to founders, is that the model that we've got is so relaxed it makes spaghetti look tense, is in terms of how flexible it actually is. And with that, we've got some businesses, right, they don't want to be paying the 3 people in front of Netflix on a Saturday. So literally just a 3-person payroll once a month. It can be that simple, and 10 AP invoices once a month. That simple. And then growing from there. And so then from there, it's gone from 3 people to might be 6 people to 50 or 100 transactions a month. And then where it's gone from there, it's like, well, actually, you know what, I'm now, and that's where we'll say, look, you know what, it now makes sense to actually have somebody in the business full time. And so with that, they bring somebody in-house, but that might even be in-house 3 days full time, 3 days full time, but we completely step out. Then what might happen, often that say that person might grow, or they might even get like a finance manager or financial controller, of which they're paying significant money to. And it's that person then, it's starting to take the data and turn it into information. They're the ones that are doing the forecast modeling, the scenario analysis and like. But then, every Monday they've got to do the payroll. Every Tuesday they've got to do the AP run. This financial controller who you're paying a lot of money to now hates their job, and you're paying them way too much money to be doing this function. So then what happens is we then often come back and step in, and our support function is we then support the financial controller in terms of doing all of this. So we support them. And or it might be we do this, we don't have a financial controller, but what they need is a CFO. So we do the bottom end, and we help on a monthly basis, monthly meetings. It might be on a board meeting, whatever it might be, in terms of having that CFO challenge. Now, but keeping in mind, a CFO, yes, look, they're often accountants, but the role is not an accounting role. It's a business commercial role. And that's that, okay, if we do X, this is going to be the impact. Do we look at this market? What are we doing with our customers? How are we raising capital? How are we structuring the business? That's the CFO role. So what we do is, it's whatever the needs and the support of the business might be at that time. So we can, and or you get a CFO, we can support the CFO so they can do what they're engaged to do. We can do a finance manager role, and you have a CFO. We can just do the AP payroll role and a CFO, or an AP and a finance manager role. And we sort of come in and ebb and flow depending on what the business needs, right from, as I say, micro, we literally do micro, right up to IPO stage. And look, and you know, we have had a couple of businesses that have got to that stage, and we continue to support and blend in with existing teams as well. Very, very flexible depending on the needs of the business.
Yep, great. And in terms of like where you think the most impactful hire is for a finance team, like is there one, or is it, I think when we've spoken, it's always like a how long is a piece of string kind of answer.
Yeah, look, you don't want to be like, well, not you don't want to. It's awesome when you get to the stage where you can afford to pay a CFO a chunk of money and your business is firing. But they're also really hard, and it costs a lot of money. And getting somebody to that. But what is also wonderful is when you get sort of a more junior person that grows with the business. So that finance manager, financial controller kind of person that can grow with the business, and often they can grow into that CFO role. And it's that piece there, and I keep coming back to this information piece, not just data processing. So when you can get to the business stage where it can afford that person to be able to be a right hand to challenge, to scenario analysis, be on the fly to bounce ideas, that can be a wonderful resource to have. But you want to use them for what you engage them for, and that's where you don't want them doing the noisy data processing piece.
Mm-hmm.
Yeah, I love that piece, and they're more available, they're keen, they're excited, and they want to get into and really get to know and drive businesses. I think that's a wonderful role.
Yeah. And do you have any thoughts on that, Mac? Or because you have the CFO experience, do you think differently about it?
No, I think that there's some really distinct roles. So there is a data processing role, there is a information provision role and governance piece, and then there's the strategic piece. And I think with early stage businesses, quite often it's the same person ends up doing all three, and invariably when they're doing all three, it's one of the three probably falls over, or at least maybe two of the three. So what I see working really well is when there's actually three distinct roles, someone doing the strategic piece, someone doing the information and governance piece, which I'll label a financial controller, and then the bookkeeping piece, which is the data side. So I think having three distinct people is really powerful. Not always, or it might be a bit of a luxury at very early stage. That's where an outsourcing model works well, because you can get fractional people in each of those roles, and the combination works quite well. But as you grow, then having those three distinct functions with employees employees or contractors, whichever way you want to go, works really well. And the most important thing from my perspective is you're after an outcome in those three areas. How you structure that and who you get to do those roles is to a degree irrelevant. You pick the most cost efficient or the most effective way to do it. So there's not, from my perspective, I don't go, well, you just got to do outsourcing or you've just got to do employees. It's finding the right combination. And a good example of that is quite often you'll see a COO, CFO combined role, and that can work quite well for people, which means that they need underneath them. They don't need a CFO underneath them. They need potentially more junior people, which can work quite well. So
there's just a quick question here. I'm not sure if this is for you guys or not, just around, maybe you can shed some light around founder liabilities where at early stages they're also directors in the company.
Oh, that's that. There's a myriad of complexity around that, but yeah, if you're a director, then you're going to be liable if you're not doing the right thing. I think that it's important that you get insurance for your activities, but to answer that one, I think I'd need to see the circumstances, and I'm probably not qualified to do it.
Look, I'll throw a couple of cents in, and this actually comes that financial literacy thing that we're doing with the Founder Elevate program. Whether you're a director in a business that's turning over $100 million, or you're a director in a business that's turning over $100,000 or $100, you have liabilities as a director. And one of those is and what's interesting, most people think when you prepare your financial statements, you make this statement of solvency, that the business can pay its debt as and when they fall due. That is not just a once a year statement that you make. It actually is an everyday declaration that you have an obligation to. And so that comes to that piece that if you are incurring liabilities, can the business pay its debt as and when they fall due? And that piece is, yes, there's processing, and where's the information? How are you managing your KPIs, being indicators as to whether the business is continuing to be solvent? Now, that being solvent doesn't necessarily mean making profits. It's can you pay the debts as and when they fall due, and you may have resources to do those things. But that is a key one as a director that you need to have an awareness around. Absolutely.
And definitely, certainly the thing I've seen people caught out with is this idea that they didn't know, they didn't know.
Does not fly.
They didn't understand, and it's like you don't have the option.
Doesn't fly. No. You've
Yeah.
incorporated your company. You've signed it ASIC. Every year you're putting in that declaration, preparing those financial statements. To not know, forget it. Never going to fly.
And I think that there's another thing too. As a director, you need to have up-to-date financials, and they go hand in hand in the solvency test, but you also you definitely have to keep your financials up to date. That's a director obligation.
Yes.
And then I think we're going to open the floor to questions, but we did just have, so if people want to sort of think about whether they've got questions to ask, but we did just have some questions there about offshoring, and whether that's a good solution, any sort of watch outs that you guys would call out in terms of that offshoring process. Is there anything that you think you should be careful of in terms of things falling through the cracks, or is anyone that should maybe not be out offshoring if they don't have a strong enough understanding of how their finances work?
I think offshoring can be really powerful on the basis that you have roles, responsibilities, and process defined. If you don't have that defined and you start offshoring, it can be, and you don't invest the time in establishing it with the offshoring partner, it can get really messy really fast. And it's like, use the word leverage. It's like putting fuel on a bonfire. It can get really, really big and ugly and expensive. So my takeaway is I think offshoring can be really good as long as it's defined. Defined and process set up.
I agree. And look, it can be absolutely fantastic, but You really, really have to manage the process, and you really, really have to articulate responsibilities. And what I would say in the majority of situations, people have used them, personally used all of those sort of things. It's been a processing function, and that's it. So you can't expect that you're again going to get any sort of, and look, and again, it might produce a report, but so what? I mean, look, I say to my own team, they produce reports. I say, so what? What does it mean? What are the KPIs telling me? Where are we going with these sorts of things? And the other piece is, it's, you know, you can't use a calculator if you don't know how to add up. You can't say an Excel spreadsheet just because you've done it on Excel means it adds up. So again, just because you're offshoring doesn't mean it's going to be processed correctly. You have to know what you're looking at. You have to know if it's going to be right. You still have to have the governance processes overlaying it to say, is this right? And is this how I want it? So you've really got to be aware of and honest about what your expectations are about the deliverables on it.
Okay.
Yeah.
So did anybody have any questions? I don't know if I've missed any on the way through. Apologies if I have, but anything else that anybody wanted to ask? Because otherwise we'll just jump to Mac and Leanne if they've got any other final thoughts. No?
Hi, it's Jackie Bond here, actually from Climate Salad.
Oh, hi.
Hi, everyone, and hi, Kylie. We've met on email.
Yeah.
This is not so much a question for me, but it's just, I'm guessing it might be interesting for the audience, and maybe for Leanne to speak to on that. Just on the solvency point, which is fundamentally important for a director, and I was sort of thinking, like, liabilities sort of come in three different, well, I'm sure they come in many buckets, but roughly speaking, you've got staff, which is obviously super important because it's people. You've got big liabilities, like obviously debt, but hopefully most people aren't going to be getting debt. But you might have big costs. Certain businesses will have big costs. And therefore the solvency point's much more important, or much more difficult for them to look forward. And then also just sort of normal accounts receivable, payable, just normal costs that you need to pay in the next month or two. I would have thought for the people on the phone, presumably some have businesses where it's much more tricky because they've got those really big costs. And for some, if your main cost is your team and generally, less day-to-day costs, it's a lower bar, or not lower bar, sorry, but just it's not as hard to get right. I'm just throwing that out there, Leanne and Mac, as for you to respond to, just in case some people, I guess, getting a bit scared about the solvency point.
No, look, not necessarily something, so to speak, to be quote unquote scared about it. However, as a director, you have to have an awareness. You do. You do. It's that simple. But if everything that we've spoken about today in terms of that piece around understanding your business, understanding your cash, and if you're doing those things, it's actually really easy because you know where you're at, you know what you've got due when, you know what you're paying when. Yep, it's no problem. And it's just, it's sort of, it's an everyday, it's pretty vanilla. But if you're not doing those things, then let me tell you, and you're incurring all these costs and you're incurring debt, then you should be worried, because how are you going to pay these things? But if you do all the stuff that we spoke about today, you get the right people supporting you, taking that data, turning it into information, understanding the information, learning about it, upskilling yourself, understanding your cash, it actually just falls into place.
And early in the piece it's easier because you know what you're spending, and you've got the money to pay. You only spend when you've got the money to pay for it. The challenge comes in as you start to grow, as you lose touch with that, as you've got other people incurring expense in your business as well.
But that comes to the point though of you've got to be engaged in it, you've got to understand it. And that's and again, the earlier you can start to learn it, because what happens is, as I go back, like if you look at an Excel spreadsheet and it sort of says, oh, it was done on Excel, so it should add up, you're like, no, that doesn't look quite right. So if you understand those things, you should get that sense of feeling, no, that's not quite right. And just because you've got other people in there, just because you've got other people doing those things, doesn't mean you can disengage in this. Not at all. You have to, as long as you stay engaged. And look, I can honestly say businesses from $100 to 10 million to all of the rest of it, the businesses that do the best are where the owners continue to stay engaged.
And to your point, Jackie, around the different types of liabilities and the different types of costs, they all add up, and they all can, in their own way, make you insolvent. I think the key point is that when you run out of money, the directors aren't liable. The directors are liable or can get in trouble legally in trouble when they keep trading when they run out of money.
Correct.
I think that's the big point.
Yeah.
So it's not, businesses go down all the time, and directors don't get in trouble because they get to a point where they run out of money and they put their hand up and say, I run out of money, I can't keep trading. It's the problem happens when they go past that point and keep going on the promise that, oh, the investor told me last week that they were interested, that money might come in, might come in, and they keep employing people or getting new people in, or they engage other suppliers. That's when they get into trouble.
And Kylie, to your point, oh, I didn't know.
Yeah.
You got to know.
And I've seen that happen. I've seen it happen to people with like bad consequences because they genuinely didn't understand. They kind of thought, no, I feel like I'm doing all the right things here. I just didn't understand that onus that was on me. So it's a very important thing to understand. One more question. Is there a question? What is the best practice around when to report key financials?
Every month.
Definitely a report package every month. I think you should be looking at a cash flow every week. Cash flow every week, and then a full reporting pack every month.
And Mac, would you agree with me too? Some people, oh my goodness, they get these financial systems and it produces all these pages and pages and pages of reports and think, oh God, I've got to go through month end. It's going to take me forever. And so people don't look forward, like it's awful, it's this thick, it's terrible. No. Again, come back to what you like, that P&L, balance sheet, cash flow. You might do a bit of dashboarding. So again, what are my KPIs? So working out what your drivers of your business are, some KPI, and again, they're indicators. You might have some like lagging indicators, you might have some leading indicators in there, a little bit of dashboarding, and then you're good to go. And if you need anything further, then you can go through the rest. But if you've got that snapshot, if these are things this is what I expect I should see, then you might put a little bit of commentary around it. That's all it needs to be. It doesn't have to be bigger than Ben-Hur. If you can make it bigger than Ben-Hur if you want to, but for that monthly pack, it doesn't need to be pages and pages long because you've got to get on with running the business.
Yeah. And look, we're about to run out of time. So I just want to really quickly thank you both for jumping on and doing this today, because I really, really appreciate you taking the time. But any final comments or any other thoughts from you guys that hasn't come up today?
Hi, Kylie. I'm Hank. I'm now doing my own startup, but I've also been an angel investor in a few successful as well as less successful businesses over time. And I thought I'd just mention a few of those businesses. Every month I would get an update as an investor. It has the financials attached. They are absolutely transparent about the challenges they are facing, about what is working, what isn't working. And the ones who send me that, when they come back asking for more money for a future round, those are the ones that I prefer. It's the ones that I don't hear anything from, that I don't get any updates from. I'm there to support, but I do, as an investor, I do love seeing those updates. They don't need to be a lot, but seeing an income statement is incredibly valuable, just as a way of just relationship building more than anything else.
Yeah, amazing. That's great feedback. And look, and anyone that wants to get in touch with Mac and Leanne, certainly in terms of Leanne and what our outsourced finance solutions can look like with KPMG, feel free to get in touch through me because Leanne is flat out. So I'm really happy to sort of be the connection point so that we can arrange those conversations with Leanne. And Mac, I think we've shared your LinkedIn. I mean, I'm not sure if you want to give us a quick rundown on the kind of investments that you guys are focused on and the kind of things you're looking for.
Super fast out. We're looking for, our business is called Mad Ventures, and MAD stands for Make a Difference. So we're looking for businesses that are making a difference in the world. So I think everybody on this call is probably in that bucket. We're investing at, if we're going to put a label on it, it'd be Series B, maybe Series A, but scale up high growth businesses is the point that we're investing at. But we're supporting businesses right from very early stage from a advisory and support perspective. So yeah, that's a bit about us. Yeah,
great. Thank you very much. Really, really appreciate it. And thank you for Charlotte for setting this up, and everyone in Climate Salad for coming along and joining us. As I said, get in touch with me if you want to get through Leanne, and we've got Mac's LinkedIn connection there. And we'll look forward to talking to you all next month.
Wonderful. Thank you so much, everyone. Go enjoy the rest of your wonderful days and keep creating impact. I will have this recorded and up on the Slack channel and sharing it out on YouTube. Thank you so much.
Thanks, Charlotte.
Thank you, team.